Hi, let's go over some techniques about valuing a bond, a fixed income. This is quite interesting because I've never covered something like this. I mean, the subject itself is really, really deep. But then let's see if I can use only like a couple of minutes, 10 minutes perhaps, and to explain to you what fixed income bond is. So very, very straightforward calculation. So as long as you understand the time value of money, right? In this case, for bond is actually a liability and an agreement from a corporation or a government or anyone that is actually promises you to pay investor or the bondholders a structure of cash flow in a defined future time. So let's say um, for plain a vanilla bond, so it is very, very the most simplest bond feature. You will get a term. So let's say in this case will be 10 years, and then the coupon rate 8%. Coupon means it is the it is actually it's a coupon that you always heard of because back in the days, almost like 20 years ago, when they first issue the bond, each year, every period when you are about time to collect the money. So let's say you invest in a bond. So let's say this is a U.S. Treasury bond, right? So what happened is they give you a note that has at the bottom sections will have a size of a stamp like a coupon. So all you need is at the time, at the appropriate time, proper time, you tear that off and then you bring it to the bank, and then when you show that coupon to the bank, and then the bank will give you the money or give you the interest that you're entitled to. And that's why we call the coupon. So even at this nowadays, we use the coupon. So this is a coupon rate, which means it is the interest rate the bond is paying. It is at 8%. Payment is 2 times a year. So usually it's March or September or June or December. So 2 times a year, but this is typical. A lot of corporate bonds or government bonds is 2 times a year. The face value, which is the sort of the principal amount, is let's set it at $1,000, and the market interest rate is at 5%. So this point is a little bit different than the usual because usually the coupon rate will be equal to the market interest rate, but this one is different because for some reason the coupon rate when they issue the bond, they issue at a higher percentage, higher than the market. Of course, a very easy economic concept. You have a higher interest rate over a higher return to the investor. You expect either like you're going to be more risky or you want to attract more people. So in this case, probably you can guess the price of this particular bond is going to be higher than the face value, which means you're going to have to pay more than $1,000 to get this bond. So how do you calculate that? So the cash flow pattern, the CF pattern. So you have every month, every 6 months, you're going to get $1,000 times 8% divided by 2. So 4% per term. So that's 4% of $1,000. That's $40. So every term, you're going to get $40. And at the end of the 20th term, which is the 10 years, because we have 2 terms a year, you're going to get the whole principal back, which is $1,000, which is face value. So in the last term, you're going to get a 1040, $1,000, $1,040. So very easy. You got 40, 40, 40 all the way to the 20th period. Sounds like an annuity to me. And then you got one lump sum, which is $1,000 from the end of the 20th year, and you bring all these 21 cash flows to the present. So when you have this present value annuity for all the payments, $623, and then the present value of the face year of a year in year 10, that's going to be $610. When you add these two up, you're going to get $1,233.84. So this is the value of a bond. How come it is above $1,000? Why don't you just check $1,000? This is called the premium bond. Of course, think about this. If this particular guide right here is going to offer like maybe less than the market rate, let's say 4%, then everything is going to change. Of course, like this is not a yellow cell, so if you change this, it won't happen. So you try this yourself. If you change the 4%, I can tell you that the value, the bond value, when you add these two up, will be less than $1,000. So this is that one is called the discount bond. So try that yourself, and you will see like you can play around with all the numbers. It is actually quite easy to understand, because if you come from an economic standpoint, business standpoint, you offer a higher interest rate, higher coupon rates than the market, then of course people are going to hunch for that, and then people are willing to pay more price for you. If you're only going to offer like a lower rate of return than the market interest rate, then of course not a lot of people is willing to buy, and then the price is going to get lower. So this is how it works for a simple vanilla bond. What is the YTM? You may heard about this quite often. In Chinese, this is 孳息率. So what is yield to maturity, or we usually call it just yield. Yield is the same thing as an interest rate. The unit is interest rate, or people call just the rate of return, or you can consider internal rate of return. So the bonds yield to maturity is its IRR. So when all the future cash flow bring back to the present and discount that equals to the current market price of the bond, then that will be the yield. So it is going to be quite interesting, because you get a coupon rate, you get a market interest rate, and then you get the YTM, the yield to maturity. So all these three numbers are quoted in percentage, and all represent different angles of interest rate. So this is called the yield to maturity. So when you have interest rate, so that's another thing we mentioned a little bit before. It means interest rate it's a very, very broad term, because you can consider a coupon rate as also one of the interest rate. Yield is also one of the interest rate. So it depends on from what capacity. So let's say if this is from the fixed income bond itself, on the note itself, it's called a coupon rate. If this is trading in the market, then it's called the yield, and then you get the market interest rate, right? So when you play around with this, then you'll get the value of the bond. This one is a premium bond. This one is called a discount bond, because the coupon rate, if the coupon rate is lower than the yield, than the interest rate, then you know that it's going to be low. So the key is this is also happen in the market world. If you are going to see, or if you expect the interest rate is going to drop very soon, then basically when interest rate drops, the valuation of all assets will go higher. Doesn't matter what kind of asset. So if you are valuing a bond, a fixed income, interest rate go down, the price of the bond is going to go up. It happens with equity as well, because we're going to explain to you why or what happened in the next session when we come to the equity valuation. So basically, interest rate go down, the value shoots up, and if the interest rate goes up, then the value is going to go down. So this is the reverse relationship. So this is something you need to take care of, understand the logic, and of course there will be something called the price yield curve. A lot of times people use in the fixed income session. So the price yield curve. So just FYI, because it is something that you should know when you are taking the corporate finance. So the higher the coupon rate, then the smaller the price volatility. And if this is lower the coupon rate, then it will be a larger price volatility. So it will be something like this. When you are closer to, so this is the price yield curve. Price is the bond value, bond price, to the yield, the interest rate. If we are in this situation, if this is a low zero interest rate environment, then the bond value change quite often. So you can imagine, if ever since the global financial crisis in 2009, we are pretty much staying at the low interest rate environment for a long time. At that point of time, a slight change in the interest rate is going to trigger a lot of things. That's why we see back in the 2022 year of 2022, a lot of guys, even the rich people, got burned. They got hit. A lot of money lost. Why? Because they bought a lot of fixed income securities because they thought it would be safe. But in fact, when you get a lot fixed income in a low interest rate environment, and if the interest rate is going to rise just 1% or 1%, the price effect is going to have a huge impact at the very beginning. So let's say we are at around 5% right now. At 5% going up to 6%, then the effect is actually minimum. This is called the price yield, or in the angle will be called the price yield curve. So this is the price, and this is the yield. The price yield curve is always a convex. Why it is not a straight line? Because of the time value of money. It's the compound effect that actually bend the straight line into a curve. So in this case, this is the one thing you may have to know about this price yield curve for corporate finance. And one last thing before I get like really into like the advanced finance, advanced fixed income or bond valuation. This is it. Again, I urge you guys to read it yourself because this is actually going to be extremely complicated. It's called a bond volatility valuation, and there are actually several different levels and different methods trying to measure the angle or the slope of that particular price yield curve. Because if this is a straight line, it will be very easy. But if this is a curve, then we have to measure like how volatile the bond price will be. Why do we need to measure the bond price? Because in the fixed income world, it will be exactly like the equity world. You want to select you want to pick the stock, you want to pick the right stock, right? In the fixed income world, it is actually, we don't have a lot of sort of criteria to select, because in equities, in the stock market, you can select the one with high revenue growth, you can select the one with low leverage, you can select the one with high profit margin, you can select the one with the several different criteria, right? But in the bond market, in the fixed income market, the number of variables is actually quite small. So if you want to compare fixed income A to fixed income B, or bond A to bond B, then the best way to do is compare the convexity, which is called the volatility valuation here. And I'm not going to spend too much time here because it is actually quite advanced, as I said before. I'm going to tell you four different aspects or four different levels. The first one is called the I have not done it here, but it's actually measuring the straight line, which is called the price value basis point. Price PVSP, price value basis point, PVBP. That's measuring the straight line. And then the next one, next category is called the duration. We have something called the Macaulay duration, a modified duration, and also effective duration. So it is a second level where they are trying to measure the curvature of that price yield curve. And the last one is measuring the convexity, which is actually also not covered here. It's actually going into more mathematical problem. A lot of PhD has to study that, and seriously, investment is not as simple as a lot of guys you saw on TV. They call the investment expert, because I've seen a lot of really advanced PhDs level colleagues. They study fixed income like this. So that convexity is measuring the second derivatives of the price yield curve. So and it is extremely complicated. So when you try to compare like one bond to another, they don't just compare like the characteristics or the features or any particular attributes. They calculate. They use a lot of mathematical formulas or simulation to try to calculate, trying to find the ones that is actually fit their investment purpose, investment objective. So that one is called the convexity measure. So in this bond volatility valuation, you have the price value basis point, which is a simple straight line. And then you have these three different durations: Macaulay duration, modified duration, effective duration, which I show you how to do that with, let's say, with the case 1, case 2, case 3, with different, let's say, maturity, different kill point rates, as you can see, and also with different yield to maturity. And you will get a different prices, and you will get a different Macaulay duration, and also modified duration. So you can see how these things work. And of course, like if you go one level down, it's going to be effective duration, and at the end you will have something called the convexity measure. So that will be very, very complicated. And for the fixed income, I'm not going to go anything beyond, but you can actually read through yourself. We have the yield curve, which I explained to you, the price yield curve, and also we have something called the term structure, which you will see. You heard a lot of economists talked about on term structure, which is the an illustration, a graph going from the years of maturity, a number of years going longer and longer period from 0 year to 40 years. And then this is the percentage of yield. This is called the term structure. And so think about this. If the bond is going to mature in the short time period, so let's say 1 year, 2 year, then you have a particular interest rate, right? And if you go further out, let's say to 15 years, 20 years, then the interest rate is going to be higher. So that will be that's called the term structure. So it's upward sloping. So from your angle will be upward sloping like this, right? So in this case, the term structure is normal. In economy is booming. When the term structure is actually reversed, we call the reverse part here. So in the sooner duration, it's actually you get higher percentage, and the further down the road, future duration, it's getting less a return. That's a downward sloping term structure, and that means the economy is doing not good, and people prefer investment in the shorter time period. So that's something people watch about a lot on this term structure. So basically, you can go through the remaining notes I gave you here, and this is about the bond in 15 minutes. All right, have fun and study hard on the bond situation. And if you have any questions, feel free to contact me. All right, bye. Well, one last thing about the bond or the fixed income securities. It is there is actually one characteristics which is quite important for investor or bondholders to understand, and it is the rating. So in the market, there are in the whole world, there are actually three independent so-called independent rating agency for the fixed income securities all over the world. They assess or evaluate corporate bonds or even government bonds. So the first one is called the Standard & Poor, S&P, and the second one is called the Moody's. The third one is also is called the Fitch, F-I-T-C-H. But people usually use the first two more often because they are considered to be more reliable. So S&P and also Moody's, and we're going to focus on these two. There are actually several grades of a particular bond. The first one is called the investment grade or high grade bond. The second one is called more like a leverage type. Leverage means the company or the country involves more debt, so they borrow more than they should be. So we call the high yield bond or the junk bond. So this is a little bit interesting because this is actually on the edge of, hey, are you guys going to be fined, or are you guys going to go bankrupt? And the last category is called default. I mean, basically nothing you need to worry if you're not the investor. But if you are the investor, then you probably have already hired a lawyers or attorney to see how you can actually get your money back. Because in default it means the company or the country is actually going into bankruptcy, or they are going into technical default or going into bankruptcy. So in the S&P, so the rating is as follows: simple rating. You have the AAA, very high class. So U.S. Treasuries, Hong Kong government. It's a AAA, AA situation. And then single A, triple B will be similar to like Microsoft, Tencent, let's say really reputable firms like let's say IBM or things like that. Very secure, long history, stable cash flow companies. You get a investment grade rating, a high grade rating. But when you hit up to some funky companies that you may not be able to pay that kind of thing, like let's say New World in Hong Kong, or something like let's say Alibaba is actually still considered to be investment grade. Amazon is one right now. But if you're going to let's say a second tier, cannot think of anything, but there are lots in the market. Then it's going to hit double B and below. So when you have a triple B minus, you are still investment grade. But then when you drop one notch, triple B minus to double B plus, then you will be switched to the high yield or called the junk bond. In that case, a lot of bondholders, institutional bondholders, is actually going to sell your part away. In this case, it's going to be a big trouble. So a lot of companies will try their best. The CFO will try their best to maintain the company's credit rating above the triple B minus. So make sure that they get the investment grade, because first of all, you will get a lower interest rate. You're going to can issue bonds at a lower coupon rate. The second of all is a lot of people will accept this kind of let's say margin as an investment grade. The worst one is the investment grade. So if you're not able to perform well and drop to like just one notch to the junk bond, a high yield grade, then it will be a big problem. So this is how it works in the S&P and also in Moody's. And you can see the default rate, which is going to the bankruptcy rate, close to riskiness. That will be like 1%. And then when you have little risk, that's 0.53% total go bankrupt. But if you are going to the high yield level, you're going to have almost like 1/10%. Not 1/10%. 1/10 of the chance to go bankrupt. And if you're going lower and lower, the chance that you're going to go bankrupt will be higher and higher. So think about Evergrande, real estate developer, which is the Hamdai Mat Yip. They go from triple B minus 2.3% chance to go bankrupt all the way to bankrupt situation right now, which is 100%. So that will make a big difference, because think about this. The bond will trade around, the triple B minus will trade around 80 cents on the dollar. So about 80% of the face value. But when you go to triple C, that means it's going to trade around 2% of the face value. So 2 cents on the dollar. So that is going to be really bad. All right, this is how I want to wrap up, and I hope that you guys will have enjoyed the readings from the bond material. All right, bye.